Welcome back to Fresh Economic Thinking. You're with Cameron Murray today. A special guest, John Humphreys from the Taxpayers Alliance. We go way back. We were office mates during our PhD, but I want to understand what is very controversial in Australia, which is taxing unrealised gains in superannuation. John, thanks for coming on the show.
G'day, Cam. Good to be here.
Maybe we should start by letting you introduce yourself to the audience. Who are you? What's the Taxpayers Alliance? I didn't know we had such a thing. What does it do in Australia, the Taxpayers Alliance?
Yep. G'day. So I suffer like yourself. I suffer from being an economist. As you said, we went through our PhDs together. I think it would be fair to say that at the time we were somewhat sparring buddies. We disagreed a few times. I found myself agreeing more and more with you in my old age. I don't know if I'm just I don't know who's changing, but it's yeah. So and I've worked consulting government, a bit of academia before, but I've landed now as the chief economist for the Australian Taxpayers Alliance, which is a pretty small advocacy group. We talk about tax ideas, try to propose tax ideas, critique tax ideas, and as a general theme, we come from a position, I think it'd be fair to say, that is we want lower taxes. So so that also means generally a smaller size of government. So we come at this from my political background. I'm a bit of a libertarian. So the ATA is also very much kind of consistent with what I already believed before I went there.
Yeah, great. Well, I mean, I'm here to have a debate, and I guess my view is that groups like yours exist because there are good, sensible things in there, and across the political spectrum. People form these groups and lobby for different causes because there is a concern. There's something genuine in all the aspects. So I actually really love the debate, and that's why I want to have you on, because we are in the middle of such a debate in Australia because the current Labor government that just got re-elected wants to change how it taxes superannuation accounts, which are our private retirement savings account that are compulsory for every worker to chip into. They want to change how we tax large accounts over 3 million. Do you want to just explain and help the listeners understand exactly what the change is and why it's so controversial?
Yeah, well, strangely, it wasn't that controversial before the election. So it's interesting to go through an election cycle where it's quite a quiet point. Election's over and suddenly everyone's talking about it. Look, it's probably worthwhile adding the extra piece of context on a superannuation discussion here. I think you can correct me. I think I'm speaking on behalf of both of us. Neither of us are a fan of the existing compulsory superannuation model. I think we'd both like to rip it down. I think we'd probably like to replace it with something different. So we'd probably argue there. But neither of us enamored with the status quo, I think it's fair to say.
I think that's right. And let me just pick up on that. And because a lot of people who listen, if I say something they don't like, they switch off and go, "Oh, I thought you're a nice guy, but now you've said something I don't like." But I just want to say we know we don't agree on a fair bit of economics, but we can understand why, and we can sort of converge relatively close to each other. So yeah, we both agree, but you would probably go for we should have tax advantage savings in some form in a voluntary manner. And I would say that's the last thing we want. But if we had that, I think it would still be an improvement. So we can sort of agree on the direction of improvement. So anyway, that was good context.
With that said, by the way, I think the reason we can converse quite easily despite disagreeing a lot is we both speak the same language. Like I've described economics as a language. If people can or can't speak it, they can converse easier or find more difficulty. We speak the same language, and that's why we can understand why we disagree hopefully without thinking the other person's evil, or at least I don't think you're evil. Yet to be seen how evil I am. Anyway, the issue here is, by the way, another potential point of agreement is I do think there should be a tax advantaged savings vehicle available in Australia that's voluntary, but I wouldn't do the tax advantage the way that it's currently done for superannuation anyway. So I would still just throw the whole thing away and start from scratch. But having said that,
okay, maybe we might return to this at the end and see how close we can get to converging on that. Yeah, but let's go.
The current version we have is that while your money is in the super funds, it's the accumulated phase, the accumulation phase. So your money in the super funds, it's being invested, it's making a profit or a return, and then that is being taxed at 15%, which for most people have if their money was being earned outside of the super fund, would be paying higher than 15% on that earnings. So that 15% is a concessional rate. So there's a few other concessions as well, but this is the area that's currently in play. And the proposal is for profits on the assets that are over $3 million, the profits attributable to those assets should have an additional 15% applied to them. At least that's the way that that's the shorthand way that it's been described in the media in most of the conversation. This gets a little bit trickier as you unpack it, and I guess the two issues that everyone talks about, I think there's maybe more than two issues, but the two that are coming to the fore is this applies to the income earned on assets over 3 million, but that 3 million level is not indexed. So 3 million is out of the realm of most people at the moment, certainly well out of the realm of what I'm planning on or what I'm likely to retire on. And so I think it's applying to less than 1% of people with super funds at the moment. And if it was only the 1%, I guess fewer people would be concerned. Given that it's not indexed over time, that's going to be applying to a bigger and bigger chunk of society. So that's one concern. I mean, to be fair to the other side, I guess the Labor response is that sometimes things aren't indexed and they're just changed from time to time by political decisions. And there's some truth to that. Although, of course, if you're making an investment decision today, it's very difficult to do it on the basis of assuming in 8 years' time there might be a bracket adjustment by a future unknown government. So it's a little bit tricky to make long-term decisions. But anyway, park that, because that's probably not where most of the fun debate's happening. The indexation issue is that first one. The second one is the way that this additional 15% is being calculated is it's not a 15% on the realized earnings of the super fund. They are calculating it by looking at the value at the end of the year vis-a-vis the value at the beginning of the year, and they're calling that the income earned, which in accrual terms is an accurate thing to say. And then they're taxing that accrual gain, and people have noticed, wait a second, that's going to apply to realized gains, i.e. money that you've got in your pocket, but also unrealized gains, the appreciation of assets that you own, but you haven't sold those assets, so you don't have access to liquid money related to those assets yet. And so this increase in value is going to be taxed, and for certain people in certain situations, that's going to create a tax liability where they may not have liquid assets to be able to pay that tax liability. And so this, I think, is the main part of the concern. What people are saying is tax on unrealized gains is the magic words that are being thrown around in the last week or so. And I guess
I've never heard those words used more than the last week. Right? We should do a Google search trends thing. It would be off the charts.
And the oddity that shows up now with such vigor, we just had an election campaign. You would have thought if people wanted to talk about this, that would be a really obvious time to talk about a coming tax policy. But yes, it's shown up a lot in the last week or so. And the third issue that isn't being discussed as much is just the general point. It goes back to perhaps our fundamental disagreement, the degree to which you want savings to be tax advantaged in the first place. So this is obviously just at a broader level going to decrease that degree of tax advantaged savings.
Yeah, so I think that was pretty clear. So just to dig in to clear up some confusion. So if I have 2 million in my super currently, let's say out of that 2 million, I earn in my account 100,000 in dividends and 100,000 in an appreciation of the capital value of what that fund owns. What you're saying is currently you pay 15% on the 100,000 of dividends or interest, but nothing on the capital gain portion of the accumulated earnings or the overall economic gain. Is that the current situation?
Well, functionally, it kind of depends what super fund you've got as well, because different super funds are going to be coordinating their tax payments with the ATO differently. So it's probably easier. That's functionally true if we stick to self-managed super funds, and I think that's probably the best thing to look at, because that's probably the area that has the most concern, because that's also the area where you're actually going to have these cash flow issues, where you may not have access to liquid assets. So in a self-managed super fund, another thing to note on this, I know that this isn't the point you were driving at here, but it might just put this here as a star, and we can come back to it later if you want. The current 15%, the 15% that already applies, in that situation, say the next year comes along, they sell that asset, they realize their gains. If they've held that asset for more than 12 months, there's also a 33% discount on the capital gains. So a lot of people are aware of the 50% capital gains tax discount. If
Mm-hmm.
you own an investment property, you own it for more than a year, you sell it, you pay that capital gains tax on 50% of the capital gains. Instead of on all of the capital gains. There's an equivalent thing in super funds, but it's a 33% discount instead of a 50% discount, bringing that effective rate from 15 down to 10. So I know that wasn't your point here, but it's worth noting that the additional 15%, the 15% top up that Labor's proposing, doesn't have that 33% discount applied to the capital gains. So that's another slight difference that's going on here that gets quite a lot less coverage in the debate, perhaps because it's a bit harder to explain quickly. But that is
Yeah.
another slight deviation from the Labor policy over the status quo.
So what you're saying is within a fund, say I'm a super fund, I've got thousands of members and I own a bunch of assets on their behalf, and right, the fund, if the fund owns, let's stick with Commonwealth Bank or BHP or whatever, if the fund owns 1 million of these shares for 20 years and never sells them and just reassigns, the membership share of that ownership, it never pays capital gains tax because it's never realizing it. But if the fund says we want to reallocate now away from Commonwealth Bank and into Macquarie or whatever, when they make a capital gain on those assets, the fund itself will be liable for that capital gains tax. And if they've held it for more than 12 months at a discounted rate, which is a third discount instead of half. Is that right? So is that right, firstly?
Uh, to be honest, I don't know the actual
Okay.
administrative details of how it's done. The part of your question where they say they're liable, that's true. So they're the ones
Yeah.
paying the tax. This fund is covering the tax, or in the case of the self-managed super fund. Although, interestingly, the provision in this Labor's proposal says that your super fund is liable to pay the tax, but you can pay it with money from outside the super fund if you like. But yeah, so that part's true. The actual administrative procedures of how they work out those liabilities, my honest answer is I don't know.
Yeah. Look, mate, superannuation is, I don't think anyone knows how the whole system works. And this is the funny thing. People go, you don't know anything. I'm like, I bet you only know the 10 little rules that you deal with every day. Because like the tax system in general, like economists sort of learn, knowledge is diffuse, right? People are very bad at seeing the system. They're very good at seeing their little part of it. So
Welcome
sort
to Hayek. Welcome to Hayek, brother. So,
yeah, I
I
mean,
got to
we
say
have
though,
common ground on that. Yes.
what you were the story you were unpacking may well be true, but I would note you were talking about a super fund. I think
Yeah,
this issue really where it's really coming to a fore is with the self-managed super funds, right? That's the
correct.
issue that I think people are primarily worried about. So even though we may not have the administrative procedure in front of us, we probably do have the information we need to go ahead with the controversial part of the
Yeah, great.
discussion.
And so I've just chat GPT'd and double checked a few things. And, I'm trusting chat GPT less than ever these days, but it does say the fund is liable, as you've described, for that capital gains, but they can also offset it with losses elsewhere in the fund, right? So you sell Commonwealth Bank and make money, but you've lost money on your Tesla shares or whatever. That all nets out at the fund level.
Well,
And you
that's
pay.
also true for Labor's policy, Labor's proposal. It's also true for that 15%. It's for the net. It's for the net capital gain.
That's right.
But the issue where it
So
really
let's
comes
get
to a
to
fore,
the
as I keep
issue because
saying,
it's
is that
sounding
the
reasonable right
self-managed
now.
super fund. No, well, the issue is if you have a self-managed super fund with not a very big diversified portfolio. I mean, these big
Yeah.
managed funds are managing a lot of money, going in a lot
Yeah.
of different directions, right? So if you have a smaller number of assets, and one of them goes through the roof, then that's not going to be offset by many losses elsewhere because you just don't have that diversified portfolio the same way a big managed fund does. And I got to say,
Yes.
by the way, it seems to me that there is my instinct, my first principles position here is just don't introduce a new tax and get rid of all the old ones. But I mean, putting that aside, right? So let's stay within the Overton window
We can smash that
here,
window later. Let's stay there for
uh,
now. Keep the audience
or even
with us.
let's stick within the Labour Party's Overton window
Okay.
to hold ourselves to an even stricter criteria. It seems to me you could introduce an extra 15% tax and just structure it in such a way as to not be capturing the unrealized gains, at which point you would still gain most of the revenue long term, not quite all, but most of the revenue. You would just gain it a little bit later. And I think you've seen my comment on this on X previously. Everyone prefers money now than in the future. But with a person with a self-managed super fund, the difference between getting the money now or having to pay the money now or in the future could be quite a significant problem for them. For the government, a slight delay in getting the money is not a catastrophic problem, and it's an accounting issue. So it seems to me there is a fairly easy way for Labor to make a tweak here, get most of the revenue thereafter, sideline all of the controversy. I mean, even if you think the controversy is fake, you'd still be able to sideline it
Mm.
politically and go ahead, which raises the question in my mind of why they don't do that.
Yeah. So, let's smash the Overton window. Are these guys doing like Trump negotiation? Just like, I'm putting some random thing out there. You're going to argue against me for the thing I actually want, which is just 15% more tax on super. I'm going to come back to your thing and then you can't argue with me anymore. I mean,
Well, this is
I'm not going to
exactly
say they're
what I
geniuses, but that could be an outcome that actually plays into their hand really well.
Well, that's exactly what I was hinting at. That's exactly what I wrote in my X post, saying like, so what is the rationale? The rationale that comes immediately to mind, perhaps because we're just watching American politics in real time, because it's so interesting. But is that if they're doing that and then they back down now, that sideline all the controversy, that have basically all the commentators who are criticizing them had basically already signed up to what they're about to propose. They get
Correct.
most of what they want. That if they were doing that, it wouldn't be politically dumb. But so far they're resisting that. Which, if they are going to keep resisting it, um, I'm not clear why politically they would be doing that.
Yeah, I'm not clear either because super is Labor's baby in a way, and so yeah, I guess these 80,000 accounts are probably not in union super funds; they're mostly self-managed. Fine, but to be clear, one of the other concerns is that people accumulate lots of super and have in the past been incentivized to put some assets into super, like their farm or their business, real estate or whatever. And the concern is that not only are you shielding that from taxation in any alternative structure you could have had, a trust or a corporate structure, but you're basically going to use it to get tax-free inheritance. But that's not the case, is it? Right? How is inheritance tax? Does that solve this problem out of super?
Uh, well, the inheritance tax would be, well, it depends what the goal is. So if you assume what the goal is, inheritance tax might be one way to achieve it through a different mechanism. Uh, I got to say, I thought you were going a slightly different direction with that. And even if you're not, I'm going to be
You take it there, mate.
yeah, I'm going to be rude enough to answer the question I wanted to hear. There is another issue that's at play here, which is I thought that was the one you were raising, the political risk premium. People have been incentivized to do something. Now their money is put into those super funds. If they change the rules of the super funds, people aren't given the option of going back and in hindsight, making different financial decisions 10 years ago. So there is a degree to which people, I've seen the argument being made that this is going to decrease people's faith and trust in the super system. I've got to say, that's not a, I mean, it's a worthwhile thing for us to say aloud in this conversation. It's not my
Yep.
primary concern, and maybe this is just because I'm too black-pilled or cynical. I think people already are mostly not treating super as their own money, right? I think people already see it as people have already factored in a very high political risk premium because I think
Yep.
people, and if they haven't, they should have factored in that money trapped by the government in mostly union-run super funds cannot be assumed to sit there safely for 50 years as the political winds change up and down. So I suspect people have already factored in a pretty high political risk premium. This kind of confirms that they should have been worried, but I don't know if it'll change behavior too much if they were already worried. So I know that
Yeah.
wasn't the question you were angling at, but
No, well, let's just, yeah, I sort of agree that, if an objective person with an eye for political risk should have had the view, oh, I can put a $3 billion farm into my super and shield it from tax. Um, yeah, that's going to last for 50 years and I'll just get it. That'll never change. I mean, you should be like, well, this could be reversed at the next election. Is it worth doing now? I'll see if it sticks around. There should have been some risk factored in. I think that's fair. And of course, there's political risk everywhere, right? I can go and get a medical degree in whatever, and then the government says, no, we're subsidizing some alternative treatment that's going to put you out of business. I'm like, well,
well, the,
okay.
the oddity in this situation, and there's no one in this conversation to defend the position of being pro compulsory super, but the advocates of compulsory super, when one of my criticisms, perhaps one of yours, is that, look, uh, there's no guaranteeing this is going to be, the rules are going to stay the same for 50 years. Um, And people aren't treating it like it's their own money, which the consequence of that, by the way, is that they don't shop around for the best deals. And that's probably one of the reasons the fees end up staying so high in these super funds. But we already agree
Yeah.
on the rip on the super funds. But the irony here is that person not in the room, their response to us right now would be saying, no, no, you're wrong. The political risk premium is low. You can trust us. And that's what we always get from our political leaders, insisting that the political risk premium is low while they simultaneously act in such a way as to confirm our fears that it's actually high. And if you'll indulge me a second just on political risk premiums, uh,
Yeah.
it is true that it can exist everywhere, but I mean the difference in political risk premiums between countries it matters hugely. You can correlate that quite well with the degree to which people are comfortable investing long term in countries. So it is
Mm.
quite an important variable to be looking at. And one little anecdote that I love talking about, telling when political risk premium comes up, and I can't remember the authors of this study, but there was a study looking at the US share market, and it was statistically significantly dropped whenever Congress was in session. And that's
All
a
right.
beautiful little indicator
Yeah.
of the existence of political. Now, it wasn't a massive drop, but it was statistically significant and noticeable continuously. Whenever politicians were sitting down threatening to pass laws, no matter what those laws were, the markets got spooked.
Oh, that's awesome. Um, look, I guess I don't buy that too much because political risk is relative, right? Look around the world. Um, has this changed our rank ordering of political risk in the nations? Like, is there now somewhere better to go to do the things you would otherwise do with highly mobile capital assets? I don't know. Maybe there's a marginal effect. What I wanted to do is think about the scale of this proposed change because people tell us it's terrible, and now we're saying it's only zero point 0.8 of a 0.5 of a percent, right, of super funds. Do you know how much money is expected to be raised from this per year?
That would have been a logical thing for me to look up before sitting down with you. Early on, I did. I'm trying to recall the number now. I recall the number getting quite high in the out years, and that would be due to the lack of indexation. But
Yeah,
so you've
but
got
let's just go
GBT in front
next
of
year.
you. So
No, let's
except
just
next
show
year, I don't
people
think
how
is
to
the issue.
ballpark
People
this,
are.
right? Like, so you got 80,000 accounts with more than 3 million, apparently. What do we reckon the average value of those accounts is? 5 million, right?
I
So
think we'd be better off just asking ChatGPT or
let's
Grok.
just do that, but let's just see how we go because some people I find, this is a chance to do a sneaky economics lesson, are very bad at multiplying a million by anything or understanding the difference between a million and a billion.
Mhm.
But if I just riff on this and go, let's just say they have 5 million, these 80,000 accounts. So we're paying an extra tax on 2 million per account times 80,000. And let's just say they earn 8% on average in total gains, right? The capital and the income. And we're charging 15% extra. We get around 2 billion per year in extra tax. So 2 billion for those playing at home is around 10 billion is around $1,000 per household per year. So 2 billion is around $200 per household in extra tax. So that's sort of the big thing. I'll now ask ChatGPT while we're live. But what I was getting at before, John, was this concern that people have shielded all these assets in super, and it's essentially a way to dodge tax. And then guess what? It gets inherited for free as well. All the baseline asset values sort of get reset, and you sort of can never really access. There's all these economic gains occurring outside the tax system. Is that a concern for you, or do you think the rules on super that uh, non-dependent beneficiaries do pay an inheritance tax on super? So if you've got adult children, they pay an inheritance tax on your super, but if you have a spouse or children under 18, they don't. Do you think that's good enough? Um, and I'm just having a look here. It's 15% on the taxed component, yeah, plus for non-dependents when they inherit super. Is that sort of also because what you mentioned
So they're
earlier is
paying the 15. They're paying the 15% thing. Yes, I was about to say I'm going to make a fool of myself, but my understanding was it wasn't just handed on to them with a complete reset. So there would still be a tax liability. Either they'd take over the asset as an assumed with the buying price as the assumption to calculate the capital gains,
oh
or they'd pay the 15% as they inherited it. But it's
Yeah.
which I
Okay.
think you just said the latter.
Yeah, they do. They do. Taxable for non-dependent, financially independent siblings, friends, adult children. That's an interesting one, actually. And I've found that a really interesting thing with super that people don't understand, that it's not treated as part of your estate when you die. It's got its own special rules, which further complicates the whole situation. I'm not sure if some of the listeners have surely had to deal with that, but I find it's an odd thing and goes to your point. Like, is it really your money? Right? So you can't even treat it as your estate would normally treat it when you die. It's an odd one.
Well, I think
So
the evidence shows that most people don't treat it like it's their money as well. They just it's a set and forget. A lot of people couldn't tell you much about their super balances, and that's not how people treat money that they see as their own.
I'm with you. Let me bring it back to this, the unrealized gains thing that has been on everyone's lips. Is there some kind of really fundamental tax principle out there that says you can't do this, or is it just we generally don't do this because when is a good time to tax? A high liquidity event like selling an asset or trading a house. So we just do it for administrative reasons because we don't want to keep track, like an accumulation tracker of all these gains, and then charge when it's liquid. Like, is there a principle otherwise that we shouldn't tax unrealized gains? What's your view? What's your personal view? And what do you think most economists would think?
Well, I don't know if I can speak for most economists, so they'd probably
Oh.
disown me. Look, I see it through the context that we'd raised before, the issue of if you've got an increase in the value of an asset, but you haven't got liquid assets to be able to pay that tax, then requiring that tax to be paid at that time puts you in a situation of potentially forced sales. So I don't know if you call that a fairness issue, a liquidity issue. I
Mm,
don't see there. I don't really see there as being some super unviolatable, got that word wrong,
yeah,
principle that never would allow you to do it as a concept. But I still think it's probably an unwise concept. And also, as we said before, no real need to when they can
yeah.
achieve most of what they want to without opening this debate.
Okay, let me pick up on that. That's interesting you say that, because that's sort of my view as well, and it's pretty puzzling how much we can agree. Um, I guess the topic's ripe. We both think super's flawed, so that's that's a helpful start. But what you're saying is an interesting one because it comes up in, for example, swapping stamp duty for land tax as a tax conversation. You've probably followed along that. People go, yeah, but what about pensioners? You're asking them for all this land tax all the time, but they're relying on the pension. Wouldn't it be better if you just kept track of that land tax liability until they died, and that it can be paid out of their estate when the estate is liquid and inheritors pay it? And I just sit there thinking, well, isn't that why we have stamp duty in the first place? Because it's a high liquidity event. People are spending hundreds of thousands of dollars on each other. That's when you can tax, right? Um, but getting blood out of a stone when there's no income there, that's probably not a good design. Like, do you have a view on that? Is the same issue there in your mind for property and land taxes? This, oh, you're asking for taxes all the time. Can't you just do it during that
Well,
asset trading event?
the other thought that came to mind as you were saying that scenario of the retired couple is a reverse mortgage. And if there's no easily available reverse mortgages, then you could have the government step in to create or ensure the existence of a reverse mortgage and kind of solve that problem. Look, the issue of wealth taxes
Yeah,
raises similar sort of concerns of access to liquidity to be able to pay the wealth tax because there's no income being earned. You could have zero income. And if you still had wealth that year, then an income tax would charge you zero because your wealth hasn't changed, but your wealth is there. So your wealth tax would charge you non-zero.
yeah.
And where do you get that money from? And of course, in Australia, we have a couple of variants of wealth taxes, land tax rates, and I would say car rego being some of the examples. Um,
We'll have to come
okay,
back to how that works.
well,
Why?
car
How does
rego
car
you pay
rego
for the
become a
what? No, I didn't say it's a land tax. It's a wealth
no, no,
tax.
no.
So
How
you
how
own an
is it
asset.
equivalent sort of to economically being a wealth tax?
Because you pay it you don't pay it based on your income increasing, right? So the income taxes are all related to the change in your wealth between two periods of time.
Yeah.
Your land tax, your rates, and your car rego, you pay regardless of what's
Oh
happening in
yeah.
your income world, right? So you're basically paying that for the crime of owning that asset. So in all cases, you're paying a price for the crime of owning an asset, even if the asset's not going up. So that's what I consider like a wealth tax category. And the income tax category, you're paying tax for the crime of improving your net wealth position between two time periods. So that's
So
the distinguishing feature in my mind.
So that sort of gets us back. So unrealized gains are a change in your wealth between two periods. I
Yeah.
think where we might agree is the illiquid assets, it's problematic, and high risk assets. Like we wanted people to take high risks and start new companies, right? And invest in new technology and throw money at it. And those are those environments where the asset value can be really volatile in the short run and with very, very limited inflows, right? And I think there's probably a European case where they introduced a wealth tax that was very burdensome on startups and highly volatile new businesses. Do you know about that example?
I don't. So you're putting me to shame here. But I got to say, like another thing to note about this, with the high volatility for startups, one potential solution, of course, is you bundle 1,000 of them together, and so you're just diversifying them. But what that does is it means sort of large venture capital organizations are going to increasingly have a comparative advantage over just people who want to take a risk.
Mm,
And it goes back to one of my constant sort of bugbears and complaints about the economy is this increased centralization
uh-huh.
of power. And I'll rant at other times about how the regulatory system effectively benefits big business over little business, and lots of other parts of our sort of tax and regulatory structure, our economic structures, benefit big business more than small business. And in this would be another case where a bigger VE conglomerate would be able to diversify that risk.
I
Smaller
see.
players wouldn't. And so you'd still have the risks and the fancy businesses being done by people who are already wealthy and connected.
Mm.
And people like you and I, or at least me, I don't know how well connected you are, would struggle to be able to, or would be disincentivized to a greater degree than our well-connected comrades.
Yeah, there's a name for that, isn't it? Compliance is a natural monopoly or something like that, right? Like the more, not a natural monopoly, but compliance is a,
Well, regulation is effectively a regressive tax on business,
yeah,
where it's
yeah.
the
The
cost impost is higher as a percentage on small business than it is on big business.
Exactly. And that's another sort of common thing to economists is we want to have these sort of open doors to new businesses when they're like, and this is why the system sort of has, um, and in lots of areas built in, oh, if you're a sole trader, you only comply with these things. If you get bigger, you comply with this. If you get bigger, you comply with that to let people sort of scale before they hit administrative burdens, which I think is a, the right way to do it. So I want to sort of let you riff a bit now, John. And Taxpayers Alliance, you reckon this superannuation thing, it's pretty weird because it was an election issue. We had the election, no one said anything. Now afterwards, everyone's panicked. And I've never heard unrealized gains as a phrase spoken more in my life. What would be your priority areas in general for taxation, given that you're the chief economist of a tax-paying research and sort of is it a lobbying group or a sort of advocacy group? What
Advocacy, yeah. Think
what
tax
what's
slash advocacy, yeah.
what what are the priorities in Australia for tax? Like, what are the worst taxes? How do we get rid of them? Um, like, we can talk about tax level as well, perhaps, if you think there's a better tax level.
Well, yeah, that's one of the differences between our take on this conversation and the tax discussion you'll see out of the Grattan Institute and a lot of other places, is a lot of the tax debate is how do you rearrange the tax mix? Whereas I think there's a
Mm-hmm.
more fundamental question, which perhaps people's answer is that they disagree with me, but there's a fundamental question of just what is the size and role of government,
Mm-hmm.
and if you think the size and role of government is less than it currently is, then the issue is not just how do you rearrange tax, but we need to be fundamentally bringing tax rates down for a series of reasons beyond just the inefficiency of taxes, but also
And would you say the way
reasons.
you do that is you go and find the worst ones and you knock them off starting from the worst? Is that your
Well,
general approach?
sure. I mean, you've got to factor in politics, which you might want to knock off the ones that are actually achievable to knock off first.
Yeah,
You don't want
okay,
to let
fair.
the perfect be the enemy of the good. So you've got to factor in the politics of it. And also, I'd quickly add when I came through economics, I was taught and I imbibed and believed for a while that when you say worst, what you're talking about is the tax with the highest deadweight loss. And I agree, knock off the worst taxes, but the efficiency cost of a tax is only one of the things that would qualify it for being a worse tax. So,
Uh-huh.
look, to my mind, the area of our tax system that it most urgently needs to change and probably have the biggest payoff for it is the income tax system. Now, to ask what is the worst tax, theoretically, it's probably not the income tax, but it's kind of the wrong question because all taxes, pretty much all taxes, when introduced at a low level. Now, I'm a radically anti-tax person, so I don't want to say this, but this is true. Nearly all taxes, when introduced at a low level, don't have that much of an efficiency cost.
Hmm.
Right? And the issue is, as you increase the rate of the tax, in a lot of taxes, the efficiency cost, the deadweight loss, goes up exponentially as the tax rate goes up. So it's just not just a linear increase. You don't just find the worst tax and get rid of that and find the best tax and shoot that up to 1 million. There are going to be taxes. Low income taxes can have fairly low deadweight losses.
Hmm.
High income taxes have a deadweight loss basically far above nearly every other deadweight loss being quoted for any other tax. And
Right. So you're saying this is right.
same with,
Like taxing at 20% is one thing, taxing at 60% is more than 3 times worse. It's like off the
yes,
charts. And
significantly. Same thing with tariffs, by the way. I mean, a low tariff, we've all been taught that all tariffs are evil, all trade good.
hmm,
Tariffs is just another tax, and the same rule applies. If it's low enough, you have an efficiency cost. It's not great. It'd be nice if we can get rid of it. It's not going to be the end of the world. You
yeah,
get that tariff up too high, and you are causing real damage to the economy. And that's true
yeah.
across a bunch of revenue heads, as they'd say it in the bureaucratic jargon. And so I think
Can I just maybe drop in an example for you because I can see you're going to say something interesting and I'll forget. The cigarette taxing tobacco seems to be an example of what you say. You can tax tobacco a little bit and it's fine. But once you get too far, now you've got a black market in tobacco. It's dysfunctionally high, right? So the optimal tax for tobacco is probably a quarter of what it is. Or what do you think it is? It's not
also,
any,
and the optimal rate depends on what you're trying to achieve. So if you're trying
yeah.
to get rid of all the, I mean, the policies taken by the government, both sides of politics, by the way, is basically indistinguishable from what you would get if someone went to organized crime and said, "Tell us what you need so that we can maximize your profits." Like if I mean, I don't think that's what they did. I'm not accusing the government of being in cahoots with the bikies, but their actions are basically indistinguishable from what they would do if they had got their marching orders. And it takes you back to the old Baptists and bootleggers, the old cliche about alcohol prohibition in the US in the 20s, where the two groups that were really benefited from alcohol prohibition and with the tobacco excise is getting to the point of being prohibitive. And the two
Yeah.
groups that benefited were the Baptists that like to bang their Bibles, and I go to a Baptist church, so I'm allowed to throw shade there. And the bootleggers who now had this, basically no legal competition against them, and were able to really cash in. So yeah,
So
tobacco's
you
clearly
yeah.
long since past the point of what we call the Laffer maximum. The point where you keep increasing the rate, eventually the revenue declines. So clearly that has passed the Laffer maximum. And it's just getting kind of absurd now. But yes, it certainly is an example of the
Yeah, so back to
issues.
income tax, you're saying at high rates
Yeah.
it's problematic. So we're going to focus there, even though in principle low rates of income tax are generally efficient and fine.
Well, less inefficient, I would say, but yes,
Yeah.
relatively. Uh,
Yeah.
and so there's okay, so we're to go on the income tax. So I'll take a little deviation from that as well. There's two very different parts to approach with income taxes, and I think they both need a lot of reform, but they have very different emotional responses from a lot of people. So one is the taxes being paid by people on relatively lower incomes. So let's say up to $50,000, $60,000.
Mhm.
The amount of tax they actually pay those are the lower marginal rates. But those lower marginal rates, as you would well know, are compounding on top of welfare being withdrawn, so that the all important effective marginal tax rates on these people, on a lot of these people, is getting prohibitive, and maybe not prohibitive, but 60, 70, 80, 90% is not out of the ordinary for a lot of family situations. And I can't give you one number because every different family situation has a different EMTR
Yeah.
schedule, which is a nightmare for anyone to try and understand. But
Can
I
I
think
just
there's a
get you
very
to
good case.
explain the EMTR if a listener's not familiar with that concept?
The effective marginal tax rates. Yes, thank you for picking me up. I should get better at that. Effective marginal tax rates factors in for every dollar you earn, how much then goes to the government, right? And so that doesn't have to be, if you earn an extra dollar, say if you're earning about, what is it? If you're on about $30,000 a year, right? And then you could you could have a promotion, or you could work a bit of overtime and earn an extra $1,000, then you would pay 16%, $160 in tax, but you would also lose. So that first part's not quite right because of what I'm about to say. But you'd lose 60% or $600 in welfare.
Yeah.
Then you would pay tax on top of it. Then actually at that income that I just picked, you'd also be paying the 10% Medicare levy, which I hope people at home have got a curious face and they think I've made a mistake there. No, I didn't misspeak. The Medicare levy is a 10% marginal rate between 25 and 35,000, which is absurd, which would be easy to reform, but no one seems to know it exists. And then you have to add all these together, right? So you end up with 60 plus, was that 16? You don't quite just add it together because there's different ways that these two systems interact, which makes for a funky and annoying tax model. But you end up with, you earn $1,000, maybe you give the government about 800 of it and you get to keep about 200 of it. And then once you start factoring in the impact of the family tax system, the family tax benefits and various other benefits, it gets more and more complicated.
So you're
But
basically saying you went and thought you were going to do this overtime, make another $1,000, but your net increase in income after you pay tax and lose extra benefits might be $200. So
yeah,
why
so
would you do the overtime for $200 instead of 1,000?
now I don't think I have the ability to share something from my screen to your screen. I actually
You
had
do.
the EMTR schedule in the background here for a hypothetical family with two kids. And just looking through here, it's 70% or over up and between the brackets. It's realistically about 80% or over for most of the income between, what is that, about 16,000 and 66,000. And a couple
Yeah.
of points, it goes over 100%. Which
Yeah.
of
So
course,
this,
there are multiple situations in our tax system, which is a bit of a different rant, but because
yeah.
these could be fixed in a more simple way. But there are multiple instances where if you do some overtime and earn $1,000, of that thousand, you give 2,000 of it to the government,
Yeah, I think if
which
you
makes
have a
no
HEX debt
sense.
as well, because the HEX repayment schedules have these fixed cutoffs. You jump over one, yeah, you earn 1,000, you lose 2,000. Um, yeah, so how do we improve on that? That seems like what we'd call the welfare trap. Like, why would I work more if I basically make the same amount of money? If my job income is 50,000 or 80,000, I get the same money in my pocket in my bank account. Why would I bother? I'll just only work a couple of days a week or whatever. How do
Yeah,
we
so
how do we fix that?
one part of the solution is welfare reform, which is another big interest of mine, but not why you've
Well,
invited
we
me on
might
here
have to have
today.
you back,
Uh,
John.
so we can talk about that one, and that's a big part of it. But on the tax side, it seems to be transparently obvious that people who are net welfare recipients earning up to $50,000, especially families earning up to $50,000, it is pointless for them to be paying tax, have the money churn around four different bureaucracies, and have the money handed back to them later. And then when they earn money, they both pay more tax and lose that welfare. So they're getting double hit on the EMTRs and that churn. Now the churn it's not the end of the world, but it's pretty bloody stupid, right? We've got hundreds of billions of dollars of churn, and some of this churn on people earning $30,000, $40,000. I would say we
Yeah,
need to try and move towards a model. Now, I understand the Overton window wouldn't allow us to do it quickly. I would do it quickly, but
yeah,
realistically, move towards a model where people caught under 40, 50, 60, somewhere around that $1,000 a year just do not pay income tax. And that was one of the ATA's proposals in the lead up to this election. We suggested a way, because normally I'm all for the big crazy ideas. I was trying to do things inside the Overton window. And our
yep,
suggestion was, how about have a 1 or 2% cut to the bottom rate each year
okay,
until you take it down from 16 to 0. Interestingly, Labor actually came out and did the first two of those. Like they've taken it from 16, they've legislated to take it down to 15 in one year and then 14 down the next year. I think there was a missed opportunity for Labor Party to just stand up and say they have an aspirational goal of getting rid of that tax bracket, making it
yeah,
so that people earning under $45,000 a year, basically earning up to the minimum wage, do not get caught in the income tax system. Do not play this stupid tax welfare churn game. Do not lose money to the income tax system whenever they earn money to
yeah,
improve their incentives. And they don't have to do it all at once. But that aspirational goal, I think, could have inspired voters potentially. That would have been, I think, good politics on one front. And also, it would be a good outcome once you could achieve it to help these people escape this sort of
yeah.
tax welfare nightmare.
So basically get rid of all this churn and high marginal tax rates. And I've written reports trying to advocate for that. Like, stop phasing it out at 60 cents in the dollar, stop taxing people at the same time, having these two things. And so many families are in this area, right?
Mm.
And in this really complicated structure, because you have a few kids, you're pretty young, you're not in your highest income years, maybe you're working part-time, maybe whatever. Um, you get trapped in this crazy chaos of the system. Now, I don't have the same problems with churn. I take a more specialization approach. Tax office deals with income side, welfare benefits deal with that. If we administer them efficiently, it doesn't matter so much. But I think we'd probably agree that maybe that's not the case, that we can administer both efficiently for those small values, for those sort of low income people.
Yeah, look, I think we probably agree that the real problem is the EMTR issue that comes from both paying tax and receiving welfare. I think the churn is pointless and there's administrative costs that come from it. It's not quite as economically diabolical as it seems at the first instance.
Yeah.
And that's probably your point that you've unpacked. But I still think it would be worth unpacking at least the churn for those people on under, I'd say, about $50,000 a year. Now, you probably have
We're
a
going
question.
to try and come to a close, John. So
okay. Well, let me say the one thing that'll
thing?
make people hate me then.
Yeah. Okay.
So I said that one on. So a lot of people, I think, are instinctively sympathetic to the idea of tax cuts for low income people. So I probably brought people with me so far. So let me make sure I send everyone away. The tax rates we have at the top level, according to any realistic estimate of the elasticity of taxable income, i.e., the behavioral change that we know people take with the tax rates, is probably raising approximately $0. I mean, our top marginal tax rate exists primarily so that politicians can prove to voters that they hate rich people. I'll say that one again, because I think it doesn't really exist. It certainly doesn't exist to improve efficiency. It's got deadweight losses of hundreds of percent. And it doesn't really exist to even raise revenue, even if you don't care about the deadweight loss, because who cares about rich people? It primarily exists to show that, don't worry, voters, don't worry. We hate rich people too. You can vote for us. I can prove it. And so I think something needs to be done at the top end as well. And if you'll let me.
I will. I want to dig into this because we're going to find some agreement again. Keep going.
Oh, dear. So I was going to say, and this is one of my big bugbears about the tax debate, is you only really pick up on this inefficiency if you factor in the behavioral change. The tax modeling done by Treasury explicitly doesn't do that. Now, the UK Treasury does, their exchequer. The US Treasury does. You can quibble about what the elasticity of taxable income, i.e. the behavioral effect, is, and there's lots of people who argue, but even if you use a lower number, you would still get a more accurate outcome than if you used 0. The modeling done by Treasury is not just an administrative oversight. The consequence of that is that when they do the modeling, the whole benefit of a tax cut comes from the behavioral change. They've assumed 0 behavioral change, therefore they've assumed 0 economic benefit. So if you're doing a benefit cost analysis, we're kind of screwed at the start. And then secondly, the cost of a tax cut is going to be exaggerated if you assume 0 behavioral change. Because one of the behavioral changes.
When you say behavioral change and elasticity, do you mean, just to help translate for my listeners, you mean, for example, I'm getting charged 45% plus the Medicare levy surcharge if I don't do so 47% with the Medicare levy.
Plus losing family tax benefit.
But let's say I'm up at the high end, right? And you're saying, well, most of the income in that area is funneled through trusts and other structures anyway, because 45% is so much bigger than a corporate tax rate or any other sort of access to splitting incomes in a trust or anything else, that the behavioral effect is that it looks like you're getting 45%, but in effect, you're only getting 30 because everyone's shifted their money. Anyone who can afford it has shuffled their money around to avoid that and get into a lower tax regime somewhere else. That's what you mean by behavioral change and elasticity. Or people will go, why would I keep working? I'm a consultant. I've made a couple $100,000 this year. Why would I only get 50 cents from each dollar that I charge you? I'll stop working. Is it? Or is
both.
Can you elaborate?
Both and more. There's about it's about 7 or 8 behavioral changes that need to be unpacked. So this is why a statistic like the elasticity of taxable income is useful, because it tries to bundle all the behaviors regardless of what those behaviors are. And even then it doesn't capture them all. So I can't remember what the start of your question was there. Help me out.
What are we going to do about this? The high marginal rates are just for show. The Treasury modeling doesn't account for behavioral changes. And so it looks like we're exaggerating everything because of this modeling. And I agree. In fact, I'll point to listeners. Years ago, you told me this, and I went and dug into it with the tax concession modeling. And now every time someone says to me, doesn't Treasury say it costs this much in tax concessions? I say, that's the maximum, because there's lots of behavioral changes you're not thinking. It could be half, it could be a quarter, it could be 3/4. We don't know. But that's the maximum. So I'm really.
And it's going to be very different depending. It's going to
That
be
was
very
you.
different depending on the nature and the style of the tax reform, and which is why we
Correct.
get such an uninformed tax discussion. Like the Liberal
Okay.
Party's tax cut going into this last election was almost perfectly designed to be the worst tax cut imaginable. I like pretty much every tax cut that can exist. They found nearly the only tax cut on earth that was going to decrease efficiency because they
Sorry,
were
which one
going
was
to
this?
their $12,000 once-off handout.
Oh, okay, okay.
The LOMITO, the low income tax offset and the low medium
Uh-huh.
income tax offset is almost designed in a laboratory to be the worst tax cut you could think of. You
Wow.
cut tax on people who don't change their behavior and you increase the marginal tax rates on people who do change their behavior. It's
Yeah.
like they
Okay.
designed it backwards. But anyway, putting this aside, the point you were making there is, if I can reframe it a little bit to how to think
Yeah.
about this, the amount of revenue you get is the tax base times the tax rate. So if
Yeah.
you put the tax rate up, you get more money, right? Well, yes, if you assume the base doesn't change.
Yeah.
And there are some situations where the base doesn't change much, but there are some situations where it changes a lot. So you kind of need to factor that in. If the base changes by enough, you end up not raising any money. Or at extreme examples, you could raise negative money. But I mean,
Yeah.
most of the time you don't get, except for tobacco recently, most of
Yeah.
the time you don't get to that point. But even if you don't get to that point, you still need to factor in the behavioral change, the impact on the base. And then one immediate response, you probably have a bunch of economists listening to this, and economists would know that the labor supply elasticity is relatively low. And so they'll be thinking, oh, this Muppet is talking about labor supply elasticity. Firstly, really low doesn't mean zero. So let's stop saying zero. But secondly, fine. That's one behavioral change. We have that, plus we have jurisdiction shopping, plus we have the different careers people go into and the different work effort they put in, plus we have different evasion techniques. I mean, there is the economics of law. If you make breaking the law more profitable, more people break the law. That's just
Yep.
a truism. And you have avoidance, you have this minimization. What's the incentive to hire a fancy tax accountant? Well, the benefit of that depends on how high the tax rates are, right? So,
Yeah.
and then it's more than just that. I think the biggest one is, and we discussed before, this incentive to invest. I think it's pretty self-evident. Your incentive to invest it comes from your expected return. So if you tax that return higher, you've decreased the incentive to invest. Now that doesn't even show up in the elasticity of taxable income estimates because you don't see it straight away. But
Yeah.
long term, this is why you're going to have you have higher efficiency costs from capital taxation normally, and that's because that these taxes drastically change your incentive to make an investment today, right? So if you're going to get a 10% return and you would do the investment as long as it's over 8% return, if the tax is 10 or 20%, you still do the investment. If the tax is 30%, you don't. So that investment just doesn't exist. And so now put aside what you think the actual elasticity is. We'll
Mm.
factor all this together and I'll say, look, I think it's 0.6. You'll say you think it's 0.4. Fine. We can quibble. We can argue. The point is Treasury currently assumes it's 0.0, which is just wrong. Use a low estimate, fine, but use something to make the
Mm.
tax discussion and tax debate more honest so that we can, distinguish between different types of tax reform and not see everything through this same old boring prism of how much does this person get? How much does this person get? Look, great, you get a tax cut. I want you to get a tax cut, but I'm an economist. I want to improve the nature of the economy so we can have higher wages long term. And no one talks about the productivity angle of tax cuts because Treasury just assumes that they don't exist.
I think some people do, and I think there is a bit of a debate. I've had debates with Grattan about that on land taxes and stamp duty. So on some, it's funny because it's depends on the politics. On stamp duty, it's all about the efficiency gains and the elasticity, and people don't move, and that's the only part of that debate. But then you're saying if I went to looked at income tax and the top marginal rates, I would just ignore that whole area of behavioral effects. Whereas in this other
Well,
tax, I only look at behavioral effects. So it's
Well, of
kind of
course you
weird
wouldn't, Cam,
how we.
because you would do it properly. But I guess I'm railing at the media as well, who seem to think that the word treasury is some sort of gold star that can never be wrong. I used to work at
Oh,
Treasury. I spoke to the Treasury tax people and said your model is wrong, and they said to me, "I know, but we'll do it anyway." And the media just reports them as correct. And when I
yeah,
criticize it, they say, "Well, but you're not in Treasury." Well, I mean,
yeah.
the behavioral change
Arguing
is
from
not zero.
authority, like I can
Yes.
look, it's right there. Like you explained it perfectly clearly to me, and I hope, and I think the cigarettes example makes sense. You've listed like a dozen behavioral changes of how people avoid having money in the tax base when the tax rate goes up. Um, like
And
it
by the way, you
seems
mentioned
pretty
before people
clear.
in the top tax bracket. We have pretty bad evidence on the size of the ETI, the elasticity of taxable income in Australia. But there's some good work, lots of stuff done in America, some stuff done in England, a bunch of stuff in Europe. And just bundling them all together, doing a meta-analysis, the big behavioral change really kicks in for incomes over 100,000. And in most of these countries, that isn't the top marginal tax rate. So we get behavioral changes long before you're on 47%. So you don't have to, it's
Okay.
not just the rich of the rich that we're messing up the tax system for here. This is
Yeah, I mean, I
100,
will tell you, what's the Medicare levy surcharge kicks in at 180,000 or something. And so
yeah, about that,
sometimes I'll be like, yeah, I'm
190.
done with consulting this year because I'm not paying. I'm sick of the tax. I don't like, it's just not worth it for the
Well, I've got
year.
that sitting here, by the way. That creates an effective marginal tax rate of 230%.
Oh, wow.
When if you combine, if you just
If you
you earn
combine
an
it.
extra thousand, or you combine the income tax you have to pay and the Medicare levy you have to pay. If you earn an extra $1,000 right at that cutoff, you earn 1,000, you give the government 2,300.
Yeah, that's like so you want to avoid that in June, right? June's coming up, everyone. Don't jump a tax bracket, don't jump a hex repayment bracket. Have a few weeks off work, unpaid leave, or whatever you need to do. Hey, John, I want
I'll
to
make a big tax-free donation to the Australian Taxpayers Alliance. There you go. I've got the
yeah,
plug in.
go for it. I mean, nothing's better than tax tax deductible donation to the Taxpayers Alliance. I mean, look, we could go on for hours. John's written a lot of interesting stuff on tax. I think I remember about 10 years ago, you wrote a report called the 30-30-30 plan or something like
Mm.
that. Is that what it was called? Which was
Yeah, it's
basically,
out of date now, but that was their negative income tax idea, which was really
yeah,
welfare reform. That's
which was this sort of grand vision of what he's talked about today with, decreasing those effective marginal tax rates when you phase out welfare and flattening off income tax. So basically, you give everyone 30,000 dollars and you charge everyone 30% interest starting from dollar one. So once you've earned 30,000, you get no, once you earn 90,000, you get no welfare, and then you charge 30% after that. Is that the basic
Well, your
story?
version's quite a bit more generous than mine was. So firstly, these numbers are
Yeah.
all 20 years out of date, but it
Yeah.
was
Yeah.
you get $9,000 and then
Yeah.
you pay 30%. And so by the time you're earning 30, you're on zero, no tax, no welfare. And then above that, you keep paying 30%.
Yeah.
It was a rounded example to get the idea across. In real life, you'd probably end up tweaking those numbers.
Yeah.
But
But the principle, I think, reflects everything we've talked about. Like, keep the marginal tax rate low, don't encourage people to switch behavior and stuff. Just broaden things out, flatten them off, and that's pretty common on all sides of economics. I would say that's
could I
that's
get
how you do tax.
now? I'm acutely aware that you've been trying to wrap this up and kick me out, but could I get one more thing in?
Oh,
Perhaps now that
mate, of course you
I've
can.
made myself the baddie. One last idea that I reckon this should be quite easy to sell amongst the normal people who listen to your show, the weirdos who listen to me, and even people who vote. We've been talking about these EMTRs, also the 10% Medicare marginal bracket, and a bunch of ridiculous situations in this country that I would argue only persist because most people don't know they exist. So a simple idea, it should work politically, is what about just sort of radical tax transparency? Each budget has to include the real income taxes, adding together all of the different things that they keep separate to hide it from us, and also has to publish several different EMTR lists for several different family types.
Oh yeah.
Making that just explicit and public, I think,
Mm,
would just help push the debate forward. Right? You don't have to change anything yet, just improve transparency. Because I think a lot of parts of our tax and welfare system only persist because they're too complicated for people to wrap their head around. You smack the people in the head with them every year. Eventually, someone would go, wait, why do we have that ridiculous regressive part that makes no sense and no one needs? Oh, yeah,
yeah.
let's get rid of it. Yes, let's do that.
Look, I'm totally for that. So I think you're right. We can get everyone on board with this. So I think a similar information disclosure thing was started, right? With when you pay your tax, it tells you what proportion goes to welfare, defense, and all that sort of stuff. There's like a bar chart on your tax return. Is that still a thing? You
Yeah,
could,
I don't find that very useful. What I'd like
I
to
know.
see is when people get their tax return, this is the tax you've paid, and this is the value of the benefits you've received from government, so that people can see themselves, whether they are net
Yeah,
taxpayers or net tax
yeah,
recipients, and people can also see the dollar equivalent value of each thing they get from government, so they can ask themselves, wait a second, that thing the government's so generously providing me, if I could have $4,000 instead of that, I wonder which would be better. So again, I'd love to see that radical transparency on
yeah.
exactly the situation people are in. And again, you don't have to change anything in the short term. Just give people the information, and I think people would start agitating for a better system over time.
Great idea. Love these good ideas, John. Mate, appreciate your time. Where's the best place for people to find what you write, your analysis of the tax system and economics and everything else?
Like taxpayers.org.au is the website, but I've been lately mostly active on X, where I'm John Humphreys 99 at
John Humphreys 99 on X, taxpayers.org.au. Go and check out what John has to say. I think that was pretty good conversation. Very interesting. Always love to chat. Thanks for coming on, John.
Anytime. Thank you.